Friends, good day. At the request of a subscriber, I decided to look into a topic of short-term strategies. Strategies where there's a week or less left to expiration. We will review the strategies themselves, their specifics, and the risks of these strategies. So let's imagine that I have chosen some series that has less than 4 days till expiration. Half a year or a year ago, I made a video about deposit overclocking. And there I explained about the possibilities of short-term strategies. I may have to repeat myself in this video, but that's okay. So, when using short-term strategies, we get into gamma trading territory, when delta changes dramatically. If we're looking at option purchases, we're interested in seeing our purchased options grow in value. And often, the most aggressive growth we see is in the short-term options. Short options are very cheap. It happens that the value of the theta exceeds the value of the vega. Vega risk tends to zero and time decay increases. Look at these put options, for example. Call options are at the money. Theta is 117, vega is 21. It's a similar situation with out of the money options. The time decay is significantly accelerated, vega is significantly reduced, while with at-the-money options we see an increase in gamma. So, what strategies can we use? Even without chart, looking at the put options, we can see that the options price at the money with strike 53 is 836. Put options at strike 49 or even strike 48 are only worth 18 points. Those options will be 50 times cheaper than the ones at the money. Why am I saying this? Well, imagine that the price of Bitcoin fell by 10%, which is $5,000. So these cheap options would be worth the same amount as those expensive options at the money. This is, of course, without taking volatility into account. If you take volatility into account, they will be worth even more. But we are now talking about a situation where the vega tends to zero as the expiration date approaches. Again, the options will gain 50 times in value. The same situation occurs with call options. Call options with strike 58 have a price now 24 points. While at-the-money options are 40 times more expensive. If Bitcoin rises 10%, these options will be worth almost $1,000, not $24. The situation could not be clearer with the simple option purchases. If you manage to catch the moment, this strategy can bring thousands and thousands of % profit in a few days. These strategies belong more to the category of lottery tickets, but weekly options are popular for another reason. These options are good opportunity to capitalize on accelerated time decay. This is because the theta is huge for these options. For example, if you sell strike 51 options, they are still worth something. I don't recommend selling options that are practically worthless. This sale will bring nothing but risk. You should sell options that have a significant premium. For example, strike 51 with a theoretical price of 220. I create a popular strategy with a simple sale of put options. What should I do if the price of these options starts to fall sharply and the options start to become very expensive? Under no circumstances should you sell these worthless options. You should think about buying them. If these options can rise sharply at any time, you should never sell them. You will not be able to apply delta hedging, and if you can, it may be too expensive and you will not cover the losses you have incurred. So, back to our option sales. I sell 1,000 contracts of strike 51 and I get a profit potential of $219. I sold the options at $219, excluding commission, of course. So how do I make this profit? The profit compared to the margin requirements is quite small, but it's not that bad for such a short period of time. In this strategy, you need to use delta hedging. With short strategies, you will not get anything by rolling because the neighboring options are very cheap. Just imagine when you buy back options at $128 and then sell options that are only worth $24. That's crazy. Plus, when you roll with short series, you get a very large ratio. So, rolling will only bring you losses in this case. Only delta hedging. Always be prepared to use it. When selling put options, if you believe that Bitcoin will maintain its current price level, you can make a scheduled delta hedge. You can set the delta hedge the conditions under which it will activate. For example, if the price drops below 52,000 or below 51,000. You can use such strategies, but only if you use a delta hedge. And this strategy may not be the best because options are too cheap and the risks they carry are too high. It is better to work with buying options. For example, let's imagine a situation where Bitcoin may cross the 55 or 56,000 level in the next few days. You can buy call options at strike 55 and sell call options at strike 56. You will get a vertical spread that will be very cheap. Bitcoin only needs to rise in price by 6 or 7% for your strategy to go in the money. I think Bitcoin can easily do that. And I have demonstrated strategies like this one in my deposit overclocking video. The maximum profit of this strategy is $844. The strategy doesn't even need to be improved with additional selling because there is no time premium after this strike. Also, in this situation, you can use aggressive volatility buying. Roughly speaking, buying gamma. This strategy is also buying the gamma. So, to catch a sharp rise in volatility, let's buy some cheap options. For example, strike 56 and strike 50 at this one. This strategy is suitable if you are expecting some significant price event that few people know about. For example, now, ETFs are approved, Bitcoin is rising, accumulating capitalization, halving is about to happen. It's all well and good, but mark my word, when the market calms down and becomes easy to predict, that's when the strongest price moves and the most important price events happen. This is the perfect environment for some black swan to appear out of nowhere. It is in situations like these that the strategies I mentioned earlier will come in handy. The strategy we created is not so much volatility buying, but rather gamma buying. This strategy works in a situation where we expect a price movement, but we don't know which way it will go. One advantage is that these options are cheap. If the movement happens, you can create orders in advance. For example, you created an order at strike 58, and when the price reaches that level, we can immediately sell 1,000 futures and fix the profit. At the same point, if there's a fall, we can create an order to buy futures at strike 48 or 47 and fix the profit. These strategies can be applied when the price is in the price channel for a long time and does not change. Remember, the longer the price is in the price channel, the more powerful will be the exit from this channel. This strategy can show astronomical profits, but if there's one thing I am asking you to learn from this video is this: never use cheap, worthless options when selling. Even a delta hedge won't help with them. But buying cheap options can be profitable if you catch the right moment. In the comments below this video, share your trading experience with short option strategies. Leave a like for this video, subscribe to the channel. I wish you all the best and successful options trading.